In January 2026, XDC Network finds itself at a fascinating crossroads, trading around $0.052, down 76% from its 2021 all-time high. The project carries the weight of unfulfilled retail expectations while simultaneously building some of the most significant institutional infrastructure in all of blockchain. And here's what makes this moment so interesting. Everything XDC has been building for the past 5 years, the ISO 20022 compliance, the trade finance infrastructure, the regulatory positioning, it's all converging in 2026 as global financial institutions accelerate their migration to new payment standards. Let me show you exactly what to expect from XDC in 2026. The critical objectives the project must achieve to drive price appreciation, and why this might be one of the most undervalued infrastructure plays heading toward the 2030 financial transformation that's already in motion. First, understand where XDC actually stands in mid-January 2026. The token is trading at $0.05291 with a market cap around $880 million. Technical indicators show 3 buy signals and 10 sell signals. RSI is at 60, neutral territory. The project is down 9.59% over the past week despite ongoing enterprise developments. Sentiment is mixed. Analysts predict targets ranging from a bearish $0.031 to bullish $0.125 for 2026, reflecting deep uncertainty about whether institutional adoption will materialize this year or continue being delayed. But the fundamentals tell a different story than the price action. XDC has $717 million in tokenized real-world assets on its network. That's not theoretical. That's operational capital from Vert Capital's $369 million in private credit, tokenized money market funds from BlackRock and Fidelity through Arcax, and various other institutional deployments. The network has processed over 801 million transactions since mainnet launch with sub-2-second finality and near-zero gas fees. This is proven enterprise infrastructure, not speculation. So what should we expect from XDC in 2026? Let's break this down by quarters and specific objectives because understanding the roadmap is critical to evaluating whether XDC deserves investment attention. Q1 2026, January through March, is about completing foundational upgrades and launching key partnerships operationally. The XDC 2.0 consensus upgrade is scheduled for H1 2026, likely Q1 or early Q2. This introduces chained hot stuff BFT consensus, reducing finality from 2 seconds to potentially 1 second and enabling subnets for customized enterprise blockchains. The upgrade also includes forensic monitoring tools for compliance, which matters enormously for regulated institutions. Why does 1 second finality matter when 2 seconds is already fast? Because in high-frequency trading and real-time settlement for securities, every millisecond counts. If XDC can match or exceed traditional financial infrastructure for settlement speed while maintaining blockchain's transparency and cost advantages, it becomes viable for use cases currently impossible on other blockchains. The Zand Bank integration that went live January 12th needs to show measurable results in Q1. Zand is a regulated UAE bank integrating XDC as their blockchain infrastructure for corporate and institutional clients. This isn't a pilot. This is production. Q1 should produce case studies, transaction volumes, and client testimonials demonstrating that banks can actually use XDC operationally. If this happens, it validates the entire thesis and creates template for other banks to follow. The Contour relaunch is critical for Q1 and Q2. XDC acquired Contour Network in October 2025. Contour was the blockchain platform for digitizing letters of credit, originally backed by HSBC, Citi, and Standard Chartered. Under XDC ownership, Contour is being revived with fresh capital and integration with XDC blockchain for settlement. Q1 objectives include establishing the stablecoin lab for pilots with banks and launching API-based letter of credit settlements on XDC. If Contour successfully relaunches and signs even one major bank for production deployment of blockchain-based trade finance, that's a massive validation. Trade finance is a $9.7 trillion market that's broken and desperately needs modernization. Contour plus XDC provides the solution. Execution in Q1 and Q2 determines whether this becomes reality or remains potential. Q2 2026, April through June, is about scaling from pilots to production volumes. The Enterprise RWA Accelerator powered by Plug and Play is scheduled for Q3, but preparation happens in Q2. This program aims to onboard projects tokenizing assets like commodities, invoices, and real estate. Partners include Fidelity and BlackRock in pilot programs targeting $500 million plus in tokenized RWAs by late 2026. This is significant because it's not just about total RWA value on XDC. It's about diversity of asset classes and number of institutions participating. If XDC goes from 717 million in RWAs concentrated in a few projects to 1.2 billion spread across dozens of issuers tokenizing various assets, that demonstrates platform maturity and reduces concentration risk. The 21 shares XDC Network EP that launched on Euronext Paris and Amsterdam in 2024 needs sustained growth in assets under management. This provides European institutional and retail investors regulated exposure to XDC without needing to custody tokens themselves. If AUM grows from current levels to hundreds of millions by mid-2026, that shows institutional appetite for XDC exposure is real, not speculative. ISO 20022 integration needs visible enterprise adoption in Q2. XDC's ISO 20022 compliance is a key differentiator, but it only matters if banks are actually using it. Q2 should produce announcements of banks or payment processors integrating XDC for cross-border settlement using ISO 20022 messaging. Without concrete examples, the compliance positioning remains theoretical. Q3 2026, July through September, is when the Enterprise RWA Accelerator officially launches. This needs to deliver tangible results. New tokenization projects going live. Institutional clients announced. Transaction volumes disclosed. The accelerator model works if it creates flywheel effects where successful early projects attract more issuers, which attracts more investors, which creates deeper liquidity, which makes the platform more attractive for new projects. Global Finternet expansion is targeted for 2026 with focus on emerging markets. Finternet is the vision of interconnected financial systems using blockchain infrastructure. XDC is positioning for expansion in Latin America, Southeast Asia, and Africa, leveraging low-cost remittance corridors and ISO 20022 compatibility for banking integrations. Q3 should show operational presence in these regions, not just partnership announcements. For example, the US to Mexico remittance corridor through Bitso integration. If XDC can process even a fraction of the $60 billion in annual US-Mexico remittances, that's meaningful transaction volume driving network fees and demonstrating utility. Southeast Asia partnerships through regional exchanges and financial service providers. Africa expansion through banking relationships and microfinance integrations. These need to move from strategy to execution in Q3. Q4 2026, October through December, is about demonstrating sustainable growth and setting up 2027 acceleration. By year-end, XDC needs to show year-over-year growth in key metrics. Total RWAs on network should be approaching or exceeding 1.5 billion from 717 million at year start. That's roughly 110% growth, aggressive but achievable if Enterprise RWA Accelerator delivers. Transaction count should show meaningful increase, demonstrating actual usage growth beyond speculative trading. The number of active validators and masternodes should increase, showing network decentralization is improving. Developer activity should be measurably higher with more applications being built on XDC. And critically, XDC needs at least 3 major institutional deployments publicly disclosed by year-end, meaning banks, payment processors, or large corporations announcing they're using XDC for operational trade finance, RWA settlement, or cross-border payments at material scale. Now let's talk about the specific objectives XDC must achieve in 2026 for the token to appreciate significantly. Because not all progress is equal. Some milestones matter enormously for price. Others are table stakes that don't move markets. Objective 1, Achieve clarity on U.S. regulatory status. XDC has been navigating regulatory uncertainty like all crypto projects. But with the Trump administration taking crypto-friendly stance and the SEC shifting from enforcement to enablement, 2026 offers opportunity for XDC to gain explicit regulatory clarity. Whether through no action letter, SEC guidance, or CFTC commodity classification, having definitive U.S. regulatory status would remove a major overhang. If XDC is classified as a commodity rather than security, institutional adoption accelerates dramatically because compliance becomes simpler. US-based institutions can participate without securities law complications. This matters more than most technical developments because it unlocks capital that's currently sidelined. Objective 2, demonstrate revenue generation from enterprise clients. XDC Foundation and ecosystem have raised capital and spent years building infrastructure. But the project needs to show that enterprise clients are actually paying for services, not just running free pilots. Whether through platform fees, transaction fees, or licensing arrangements, demonstrating revenue proves business model viability. If XDC can disclose even 10 to 20 million in annual revenue from enterprise clients by year-end 2026, that transforms the investment narrative. It's no longer speculative infrastructure that might get adopted. It's operational infrastructure generating revenue and profits. Market multiples for profitable enterprise blockchain platforms are dramatically higher than for speculative tokens. Objective 3, reach $2 billion in tokenized RWAs by year-end. This is aggressive. Going from 717 million to 2 billion requires 179% growth. But it's achievable if multiple large issuers deploy. A single Fortune 500 company tokenizing 500 million in commercial paper on XDC makes substantial progress toward this target. 2 or 3 large real estate tokenization projects at 200 to 300 million each gets you there. Why does 2 billion matter? Because it's the threshold where XDC moves from experimental platform to established RWA infrastructure. At 2 billion, you have enough diversity and liquidity that institutional investors view it as viable ecosystem rather than niche experiment. This attracts more capital, creating flywheel effects. Objective 4, achieve public endorsement from a top 10 global bank. XDC has partnerships with SBI Holdings, relationships through Contour with HSBC and Citi, integration with Arcax that serves major institutions. But what's missing is a top 10 global bank publicly stating they're using XDC for operational settlement or that XDC is preferred blockchain infrastructure for trade finance. If JP Morgan, Bank of America, HSBC, or similar publicly endorses XDC, market perception transforms overnight. Retail investors who've ignored XDC because it's not hyped would suddenly pay attention. Institutional allocators who need social proof before committing capital would have the validation they require. And competitor banks would feel pressure to evaluate XDC to avoid strategic disadvantage. Objective 5, maintain or exceed current technical performance while scaling. XDC's 2-second finality and near-zero fees are competitive advantages. But these need to be maintained as transaction volumes increase. If network congestion starts causing delays or fee spikes, the value proposition weakens. The XDC 2.0 upgrade needs to deliver improved performance under load, not just theoretical capabilities. Demonstrating that XDC can handle 10x or 100x current transaction volumes without degrading user experience is critical for institutional confidence. Banks processing millions of transactions daily need certainty that infrastructure won't break under production loads. Stress testing and transparent reporting of network performance under various conditions builds this confidence. Now let's address the ISO 20022 trajectory toward 2030 because this is the macro context that makes XDC's positioning so interesting. ISO 20022 is not optional for global financial institutions. It's mandated. Swift completed migration by November 2025. The Federal Reserve's FedNow launched with ISO 20022. The European Central Bank requires it for all payment systems. This is the new global standard for financial messaging, and it's not going away. By 2030, virtually every major payment system globally will use ISO 20022. This creates enormous opportunity for blockchains that natively support the standard. Traditional financial institutions upgrading their messaging infrastructure are simultaneously evaluating whether to upgrade settlement infrastructure. If blockchain can provide instant settlement at dramatically lower cost while maintaining ISO 20022 compatibility, why would banks continue using slow, expensive legacy systems? XDC is one of only 3 major blockchains that are ISO 20022 compliant. XRP and XLM are the others. This creates interesting dynamics. XRP focuses on cross-border payments and remittances. XLM focuses on financial inclusion and connecting financial institutions with underserved markets. XDC focuses on trade finance and institutional settlement. They're complementary rather than directly competitive. The vision where XRP handles consumer remittances, XLM handles micropayments and financial inclusion, and XDC handles institutional trade finance and RWA settlement is actually plausible. All 3 settling using ISO 20022 messaging creates interoperability. A payment could originate on XRP, convert through XLM for micropayments in developing markets, and settle large trades on XDC. This is the Finernet vision, interconnected financial systems using common standards. For XDC specifically, the path to 2030 is clear if execution delivers. 2026 is foundation year. Technical upgrades complete. Regulatory clarity achieved. First wave of enterprise clients operational. 2027 is scaling year. Multiple banks using Contour for trade finance. RWA tokenization reaching billions in value. Developer ecosystem maturing with hundreds of applications. 2028 is adoption year. ISO 20022 migration complete globally, and XDC is established infrastructure for settlement. Network effects accelerating as more usage attracts more liquidity attracts more usage. By 2030, if the thesis plays out, XDC could be processing trillions in annual settlement value across trade finance, RWAs, and cross-border payments. The $9.7 trillion trade finance market alone, if XDC captures even 10% of settlements, would be nearly $1 trillion in annual volume. At scale with millions of transactions, even minimal fees generate substantial revenue that flows to network operators and token holders. Price predictions for 2030 range widely. Conservative estimates suggest $0.80 to $1.20, representing 15x to 23x from current levels. Mid-range forecasts propose $2 to $5 if mass adoption in trade finance occurs. Bullish scenarios, assuming XDC becomes dominant infrastructure for institutional blockchain settlement, suggest $5 to $10 or higher. Analyst Lee the Captain outlined scenarios of $0.80 representing 10x, $0.90 representing 11.5x, and $1 representing 12x based on ISO 20022 compatibility and real-world use cases. But 2030 is 4 years away. What matters for 2026 investors is whether the foundation being built justifies current or higher valuations. At $0.052 and 880 million market cap, XDC is priced for uncertainty. The market hasn't decided whether enterprise adoption will materialize or continue being delayed. If XDC achieves the objectives outlined for 2026, demonstrable revenue, $2 billion in RWAs, bank endorsements, regulatory clarity, the market will reprice accordingly. Conservative 2026 targets around $0.09 to $0.11 represent 73 to 112% upside from current levels. That assumes moderate success on key objectives. Optimistic scenarios where multiple catalysts align simultaneously suggest $0.15 to $0.25, representing 188 to 381% upside. These would require outsized execution, but they're not impossible if regulatory environment, institutional adoption, and market sentiment all turn positive. The downside case is that adoption remains slow, price drifts to $0.03 to $0.04, and investors who bought at current levels face 23 to 42% losses. This happens if enterprise clients continue running pilots without production deployment If regulatory uncertainty persists, if competition from other blockchains or traditional fintech captures market share, XDC expected to win. So what makes XDC an interesting project for 2026 despite the risks? Several factors converge that create asymmetric opportunity. First, the infrastructure is real and proven. This isn't vaporware. XDC processes real transactions for real institutions. The technology works. The question is whether usage scales, not whether the technology is viable. Second, the macro environment favors institutional blockchain adoption. Regulatory clarity improving. ISO 20022 migration complete or nearly complete. Banks under pressure to modernize infrastructure. Tokenization becoming accepted practice rather than experimental. All of these create tailwinds for projects like XDC that have been building through the bear market. Third, retail attention is elsewhere. Most crypto investors are chasing meme coins, DeFi yields, or speculating on Bitcoin and Ethereum. XDC flies under the radar because trade finance reconciliation isn't sexy. This creates opportunity for investors who understand institutional adoption curves. When retail finally notices that XDC is processing billions in institutional transactions, the easy accumulation phase is over. Fourth, the partnerships and positioning are stronger than market cap suggests. Deutsche Telekom running validator infrastructure, Circle providing native USDC, Arcax tokenizing funds from BlackRock and Fidelity, SBI Holdings partnership, are three-quarter interoperability. These aren't paid endorsements. These are operational integrations by sophisticated institutions. Fifth, the token unlock schedule is mostly complete. Unlike projects with massive future unlocks creating persistent sell pressure, XDC supply is largely circulating. Future dilution is limited. This means price appreciation from adoption flows more directly to existing holders rather than being absorbed by new supply. The critical question for investors evaluating XDC in January 2026 is time horizon. If you need returns in 3 to 6 months, XDC probably isn't optimal. The institutional adoption cycle moves slowly. If you're willing to hold through 2026 and into 2027, watching for achievement of the objectives outlined, XDC offers compelling risk-reward. The project is positioned at the intersection of three massive trends. ISO 20022 migration, creating need for compliant blockchain infrastructure. Real-world asset tokenization, accelerating as institutions recognize benefits. And trade finance digitalization driven by cost pressures and regulatory requirements. XDC addresses all three simultaneously with proven technology, strong partnerships, and clear roadmap. Whether execution delivers on the roadmap determines whether XDC appreciates 2x, 5x, or more over the next few years. But the foundation is solid, the market opportunity is enormous, and the positioning toward 2030's financial transformation is strategic. For investors who understand enterprise infrastructure plays and can tolerate volatility while fundamentals develop, XDC in January 2026 might be one of the most underappreciated opportunities in crypto. The path from $0.052 today to $1 or more by 2030 requires achieving the quarterly objectives outlined, demonstrating revenue and RWA growth, securing regulatory clarity and bank endorsements, and executing on ISO 20022 integration at scale. Each milestone reduces risk and validates the thesis. And each achievement makes the next step more probable as network effects and institutional confidence compound. This is not a get-rich-quick trade. This is infrastructure for the next decade of global finance. And infrastructure plays reward patience, not speculation. Know what you're buying. Calibrate expectations to realistic timelines. And position accordingly for a multi-year hold with the understanding that institutional adoption, when it happens, can move faster than expected once critical mass is achieved.